Welcome to Trillions. I'm Joel Weber.
And I'm Eric Balchunas.
Eric, a friend of the show who's also on Bloomberg Radio and does podcasts here like Masters in Business, has a new book. His name is Barry Ritholtz, and the book is How Not to Invest.
Yeah, no, he's one of a kind. He was on this show, I don't know, a couple of years ago.
We've had him on the podcast at least twice.
But he was the only one where we had to do a double episode.
Because it was so long?
Yeah. And so
use your disillusion.
Use your disillusion 1 and 2. And this time we definitely got, you could see we could have gone on and on and on. He's so interesting. This book is chock full. It's basically called How Not to Invest. I read it and found a bunch of passages that were really interesting, some funny, a lot of Malcolm Gladwellian kind of little factoids in there that are metaphors for the market. Just a lot to unpack and chew on.
Also, we're going to disclose that this interview was recent, and there have been a lot of things happening in markets of late. What's interesting about Barry, though, is he's seen a lot of stuff, so he can kind of go a little bit more high altitude. So this is actually maybe the perfect year to be talking about a book like this. Joining us on this episode, Barry Ritholtz, co-founder, chairman, and chief investment officer of Ritholtz Wealth Management. This time on Trillions, How Not to Invest. Barry, welcome back to Trillions.
Well, thanks for having me.
So this book is not small. I think it's like approximately, it's more than an inch, maybe less than 2 inches thick.
It's deceptive. There's, a few hundred endnotes, and the chapters are really short. They're a page and a half, 2 pages, 3 pages. So there's a lot of blank space. I had to argue with the publisher not to start each chapter in the middle.
Yeah.
I made them start it at the top of the page. Otherwise, it'd be like, Barbara Streisand's autobiography. It'd be 950 pages long.
So not your first book.
Not my first book. The last one was Bailout Nation, was 15 years. I crank them out every fifth. The sequel to this, 2040. There's no stopping that time.
What possessed you to write How Not to Invest?
So, it has been a while since the last book. And in between, we just happened to launch a firm and have been growing it over the past 12 years. And I've had a number of friends and publishers and people kind of nudging me to do another one. And my answer was, we've had hundreds of thousands of books over the past century telling people what to do. And most investors are still pretty mediocre. And, I came home one vacation between Christmas and New Year's. You have those few days to kill before everybody goes back to the office. And I just started thumbing through some old quarterly calls and market commentary and research notes, and it seems like every other thing I wrote was debunking some nonsense or another. And, I just happened to start channeling Charlie Ellis, who wrote Winning the Loser's Game, where he compared tennis to investing, and it's 2 games in 1. Instead of trying to score points, how about just make fewer errors, and you come out way ahead?
All right, so this book, as Eric mentioned, filled with hot takes. We've got a few that we've plucked, and we want to discuss them with you.
All right. By the way, I don't think they're hot takes because everything in there I've kind of discussed, granted, in much, much shorter format. Some stuff like the Cisco fortune cover, I first wrote about that in the year 2000 to crickets. So it might have been a hot take then, but nobody knew who I was.
Appreciate your humility. We're going to call them hot takes.
If we went to a RIA conference, these would not, or a Bogleheads conference, these wouldn't be necessarily hot takes. But inside a media apparatus as big as Bloomberg, a lot of these are somewhat controversial and definitely challenge a lot of the things you hear out there.
For instance, number one,
nobody knows anything. This is what you say. One of your favorite quotes from William Goldman, who's a Hollywood guy. I think he directed The Exorcist.
No, he's a scriptwriter. He won 2 Oscars, one for All the President's Men, the other for, I'm drawing a blank on it, maybe it was Butch Cassidy and the Sundance Kid. He wrote The Marathon Man and famously wrote The Princess Bride, which later became a Rob Reiner cult favorite. A buddy of mine gave me a copy of that book decades ago. I loved it. And when I moved my blog in 2003 from Yahoo GeoCities to 6apart Typepad, I needed a name. And his new book had just come out, William Goldman's new book, and it was called The Big Picture. And I'm like, done.
So in this overall section, there's a really cool thing on the Beatles, Joel, where Ed Sullivan turned them down twice. I didn't know that. And then after they were on the Ed Sullivan Show, which is how they made it and, how they got exposed in America, all the papers were basically like criticizing them. They're like, this isn't going to last, that they aren't good. He's basically laying the groundwork that Hollywood misses a lot, the music industry misses a lot, finance misses a lot. Then he goes into people like Larry Summers and Michael Burry, which I thought was interesting because Burry had that one big call, but then you list about 10 other times he was wrong.
Big Short being that call.
Right.
And, you talk about how nobody knows anything. I mean, just elaborate a little bit.
Sure.
Like, that really challenges a lot of the whole complex.
Well, stop and think about Wall Street's training program, of which there are fewer and fewer these days. It's about a year-long training program, at least it used to be. And about a week of it is modern portfolio theory and asset allocation. And then 51 weeks is essentially advanced sales training. And there's this very much fake it till you make it attitude. I mean, we've all kind of been there. You walk into a room, it's filled with people who've been doing this longer, no more than you, and nobody wants to say, I don't understand this, I don't know. So that in finance is pretty endemic. But when you step back and objectively look at what do we really know, when do we know it, what do we know about the present, it's pretty clear most of us are pretty misinformed about the present. What we recall are mostly, rose-tinged nostalgia in the past. And what we're looking for is, one part guesswork, one part wishful thinking. And so when you use the examples of how many studios passed on Raiders of the Lost Ark, Star Wars, E.T., the list is endless. When you look at Squid Games, couldn't get made for 10 years. John Wick, despite a stellar cast and the guys who did the stunts and special effects on The Matrix, which was a giant franchise, Keanu Reeves had to write a check out of his own pocket to finish the movies. I'm assuming he got points. This is now a $2 billion franchise. Nobody wanted to make it. Nobody wanted to show it. People had no idea what was going on with it. So I am probably the wrong messenger for the concept that finance and investing requires more humility than we bring to it. But as you're reading all these things, it's pretty obvious that we really don't have a good idea of what's happening now. We know even less about what's coming next month. And next year is such a long period of time that randomness disrupts even the most thoughtful forecast. Think about who was forecasting a pandemic in December 2019, who was forecasting either double-digit losses in stocks and bonds in 2022, the fastest 500 basis point increase in Fed hikes, this is just 1 year, the Russian invasion of Ukraine, the Gaza attack, and the response of Israel to Hamas. Like, nobody was talking about these things happening. And so whatever your forecast is, it's really easy to be derailed. And if your investing requires you to see the future, you're in trouble.
So when I was writing my ETF book, I had this same premise. I was like, and I asked your colleague, Josh Brown, who you work with, and he's on the other channel. We won't name the channel. But I said to him, why even have a media, like a TV station at all? Like if all of it means nothing. And he basically said something like, well, look, if you turn on ESPN, just because they say, such and such, this player is washed or this team is not good, nobody's acting on that. It's just basically like more information.
Entertainment.
Yeah, it's basically somewhat entertainment, and that's the general idea behind a lot of financial media. It's just to give you information around these things, but not necessarily investment advice. That was his take, because I did find he has the same opinion, but he also goes on and talks about stocks.
Right. And he talks about stocks in his personal accounts. It's not how we manage money. We're not stock pickers. So essentially, you go back to when I was a kid, once a week on Friday night was Louis Rukeyser for an hour.
Yeah, Wall Street Week.
That was it. That was the entirety of the financial mediascape. Yeah, you had the Wall Street Journal and you had Barron's on weekends. I remember sitting out in my backyard at the picnic table with a cup of coffee, thumbing through Barron's, because hey, I was starting on a trading desk and I wanted to learn what the hell was going on. When you're young, you consume everything. And as you get older and older, you learn to filter everything and just select the best of what you can select. So, the concept that it's just entertainment, if that's all it is, then you got to wonder why the advertisers are getting such big bucks. The reason we went, at one point, we were peak financial media landscape when there were, I want to say 4. So there was CNN, CNBC, Bloomberg, Fox Business, CNN, FN, to say nothing about a whole bunch of other shows. And now we're down to 2.5, 3 channels. I kind of liken it to somewhere between ESPN 7 and the Weather Channel.
El Ocho.
If you're really into Australian rules rugby, you know where to find that.
It's ESPN Plus now, I think.
Right?
Yeah.
But the Weather Channel is when there's a storm a-coming, we all flick to the Weather Channel, and that's what financial television has really, when their ratings go up, when everything is clicking for them, it's in response to a storm. Always ask yourself a simple question. Anybody who's sharing financial advice with me, what are they selling? If you don't ask that, then you're a little gullible and a little naive, which, by the way, I very much was early in my career.
Well, disclaimer, because you are selling something other than a book, too.
And I put that in the book.
Yeah,
I actually out myself as, hey, listen, I run an asset management firm. I have a podcast. I have a blog. I want your time, attention, and money. It's pretty straightforward, but I try and be honest about it and say, here, it's right here. It's very public. Now, our business model is a little weird because we're very un-Wall Street. It's like, hey, you could do it yourself. Here's how. Knock yourself out. And the 0.01% of you that don't want to do it yourself, we don't have any minimums. We're happy to take your cash. And we have some other things we do along with it, tax and estate planning and all the fun bells and whistles that go around wealth management. But essentially, everything we produce in the firm individually is all, here's how to do it better than you've been told.
And, he kind of stole thunder from the second point, which is he says the majority of what the media turns out is irrelevant. Let's dig into this a little bit.
We've hit this.
Yeah.
Well, the word is ephemeral. It's ephemeral, and that means it has a very short shelf life.
One of the areas I was fascinated by, and I see this a lot, is denominator blindness.
Yeah.
This is a really interesting concept about purposely leaving out the denominator to make it sound more sensational.
So if you hear a company laid off 10,000 workers, what does that mean? Is that a lot or a little? Is it a regional company with 30,000 employees? Laying off 33% of your staff is giant. Is it Walmart? That means one person every 5 stores is losing their job, which probably happens every day randomly anyway. So you need the context. And, there are some really funny examples of denominator blindness in the book. So the 3 things I always talk about: layoffs, stock sell-offs.
We'll talk about that for a minute. So the Dow and points thing, which drives me crazy.
Right. Stock sold off 500 points today. Well, if it's the S&P 500, that's a 10% drop. And holy cow, that's a giant whack. If it's the Dow, it's less than 0.5%. And, that's normal daily trading. Why do we care about that?
Do you think that they purposely leave it out in order to get the clicks? Is it ignorance or clickbait?
I'm not quite in the full conspiracy X-Files. There are no such things as coincidences. But, as you know this, I always have to tell this to people. When you write a column, you're responsible for all these things except the headline, right? The editors write the headline. And so the editors want there to be reads. They want there to be clicks. No one is going to read the headline, 0.01% of Walmart's employees were let go. No, nobody's going to read that. But 10,000 people fired at Walmart is a big headline.
And this is something I
feel
deal with.
that you're coming for me as an editor here. So
there's a lot of subtext going on here.
Yeah, no, you should see the dirty looks.
Okay,
the dirty looks going back and forth between these two guys. It's really.
We also have 3 words, the most important words in investing. What are they?
According to Barry, and I think I agree, I don't know. I remember interviewing you once, I don't know, maybe 10 years ago when I first met you.
Really?
Something like that. And you said something, I'm like, yeah, this guy's on. I love this. He goes, he goes, I said something about this dichotomy of having an opinion, but then also saying, but I don't really know. And he said, but saying that the future is inherently unknowable will not get you on television.
Right. Absolutely.
You can't go on there and say, I don't know. And so there's this motive to not say, I don't know. Yet I think at the end of the day, a lot of people would admit they don't know and the future is unknown.
So I think that's a given. By the way, are any of these hot takes that are controversial yet? I don't think any of these are.
It's elegant BS.
Okay. So here's a little pushback that I thought was kind of fascinating. Someone asked me, a client asked me, so the whole COVID-19 thing, was that a designed bio-warfare weapon that escaped the lab, or was it something that trans-species hopped from the wet market? And perfect teachable moment. I'm like, not only do I not have the slightest idea, I'm aware that I have no national security clearance, so I don't know what those guys know. I'm not a virologist. I'm not an epidemiologist. But here's the important thing with...
But I did watch financial television this morning.
Right. I stayed at a Hamptons Inn. But why do you feel that anybody outside of a tiny sphere of experts should even proffer an opinion about that? It's not just that you don't know, because if you remember during the pandemic, we had this rotating cycle of fake experts, right? First, you're an expert in vaccination. Then you're an expert in constitutional law. Then you're an expert in war strategy. Then you're an expert. It's like, here's an idea. I understand the American school educational system is built on standardized testing, but you're not obligated to have an opinion on everything. And I really like the way Warren Buffett describes it. In investing, you could stand at the plate with your bat on your shoulder. There are no called strikes. You could just wait for your pitch. I think that includes when you go on TV, you don't have to, and you are an expert in a given space, you don't have to engage in epistemic trespass and opine on areas of which you have zero expertise. I do annual mea culpas every year, and here's what I got wrong. I can't tell you how often when I get something wrong, it's because I kind of ventured out of my area where I have expertise and allowed myself to wander into areas where really I have no business speculating or opining. And that is a relatively rare perspective in finance.
I also think, I don't know, in my opinion, if you broaden it out to politics, religion, there's so much, a little I don't know goes a long way towards just soothing a lot of division. Like, people get stuck in these rigid things and it just creates all kinds of friction, I think. So I don't know, to me, is almost like a philosophical outlook that I think is very positive.
Go back to Socrates, go to Aristotle. I think it was Socrates who said, the only thing I know is how little I know. And so that's 3,000 years ago. None of this is new. It's just sort of placed in a different context. And when you look at the example I like is Theranos. When you look at how many people from outside of medical field, devices, biotech were on their board, none of those guys had any clue what was going on. And how are they capable of identifying if it's a fraud or not? They just saw the coverage. Everybody relied on everybody else's, they must have done their due diligence, and apparently nobody did.
There's another quote that was in this section. I don't think it's totally related to I don't know, but it kind of is a little bit. It's from Eddie Elfenbein, who's a famous stock picker and has an ETF. Anyway, he says, somebody says, this market reminds me of 1987. The response is, really? You think the market will return 35-fold over the next 37 years?
That's your voice.
No, that's Eddie saying it, but he couldn't. It's irresistible. I see why
I had
it's
to
so
use
good.
It, right.
That reminds me of right now. There's a lot of like, oh, and I'm like, I think a lot of people have settled into not selling. And I think the Bogle, give him a lot of credit, Vanguard, cheap index funds, people can get married to that product. And they're like, I can't market time. And if I do, I'll sell it. And they just like, the hell with it. And I'm not going to go to an active manager. So the passive money, which you are a part of, never sells. And I think has seen through some of this stuff and is like, I don't really care what you say.
And I think the passive money found its way to BlackRock and Vanguard not because of an admission of I don't know. My pet theory, and you could see it post-financial crisis, is think about the decade leading up to the GFC. So you had the analyst scandal and the IPO scandal, and you had all these crazy things going on. That's before, the financial crisis and before Madoff and all this stuff. And it just got to the point where it felt like mom and pop took their ball and went home. And by ball, I mean money, and by home, I mean Vanguard. That's kind of, hey, you know what? I need to invest for the future. I'm saving for buying a house, paying for the kids' college, retirement, whatever, but I don't want to pay high fees, and I'm not confident that anybody who's picking stocks for me is doing a good job, so I'm just going to own the whole market, see you in 30 years.
By the way, he gave me that quote for the Bogle effect. You got like oldies but goodies. I think that was that's literally in my book, which I interviewed him saying the same thing about 4 years ago. But real quick, yes, that's true, and you see the passive flows. Our team has this phrase called the Vanguard put. So there's the Fed put, the Trump put, and the Vanguard put. I think Josh calls it the relentless bid.
The relentless bid. That's
now,
exactly
you're
right.
You're a Vanguard investor, or like it, you're an index fund investor. Can anything happen over the next, 7-8 months that would get you to take all your money out of the U.S. stock market?
The only time I've done that was the end of 2007. And I was pretty public about talking about we were short a bunch of companies. This is back when I was at an institutional shop. We were short a bunch of companies, pretty famously got into a yelling match with Charlie Gasparino over being short Lehman Brothers. He did me a giant favor. Who are you going to believe, Ritholtz or Dick Fult? And it turned out that clip, I wish that clip was still around. But what made that kind of unique is how unbelievably obvious it was if you looked at it from just the right perspective. You had to squint. It was almost like a 3D poster that, you had to catch it just right. If you looked at it from traditional things, hey, the market was trending higher. Profits were still relatively high. Yeah, there's some problems over at real estate, but it's contained. So I would never say never. And we're not, just so you know, we're not pure index investors. First, that should be the core, whether it's VTI, Vanguard Total Market, or BlackRock, pick your poison. And that's the tree, and you decorate it with ornaments and garlands. And some people like shareholders yield, momentum, Japan, India. My favorite example is emerging markets, small cap value. If you want to hang that on your tree, knock yourself out. But as long as, you'll never get alpha if you don't even get beta. And that's kind of why indexing should be, pick a number, 50, 60% of your portfolio. That's your core. And then whatever you want to do around that, knock yourself out.
I'm writing that quote down.
You can't get alpha
if you never get beta.
Right.
It's good.
Stop and think about that. Wait, you're trying to outperform the market. You're not even getting what the market's getting. You're underperforming. And by the way, I love the research, and I think the chart I used was JP Morgan's chart. I love the research showing not just that investors underperform the market, they underperform their own investments, which sounds impossible, but it just means they're buying high and chasing stuff. And, ARK, I think Cathie Woods is both overly feted and gets a bad rap unfairly because she put up one of the greatest years in mutual fund and ETF history. It's not her fault that 92% of ARK investors decided to buy after a 300% move up. That she picked some great things and they went straight up. Everybody piled in late. That's human nature. That's not her fault.
Okay, the next hot take.
I tweeted this out. This got a lot of people going. Okay, the dollar has lost 96% of its purchasing power over the last century. That
says idiots.
You say it's the most misleading claim in all of finance.
Yes.
And you say the dollar was not meant to be a store of value. It's a medium of exchange.
Isn't it?
I put this out, and I don't know if you know Joel, but I've got more crypto followers these days.
Yeah.
And a lot of people did not like it. They said, oh, what's...
Hold on a sec. You're telling me people who have a vested interest in an alternative currency to the dollar are not happy with me calling them out on their BS sales pitch? Go figure.
This is my favorite reply. Ready? I really like Barry, but I think he's institutionalized in a failing system.
Of all the things, I've had people tell me I should be institutionalized. I get that. But here's the reality. By the way, let's start with a meme and then we'll go back to the past century. The meme really that I love, which shows up on TikTok Investors, which is fantastic.
I love that. I love that.
Fantastic feed, is they show Kevin from Home Alone. And if you remember, he goes to the supermarket by himself. Are you here by yourself? No, I'm 8 years old. Do you think my mother would let me come here? And he buys $20.52 worth of groceries in 1990. I think that's when the movie came out. And then the gold bugs, the crypto people, a lot of people are like, today, buy that same thing today is $57. And I'm like, well, let me ask you the obvious question. It's 2025. Are you working? Yes. So when you buy groceries, are you using $2025 or are you using $1990? Because why would you put $57 away in 1990? I'm going grocery shopping in 2025. That's number one. Number two, you talked a little bit about denominator blindness. Hey, if this is how much groceries went, well, we work for a living and we buy groceries with our wages. How have wages done over the same time? And as it turns out, wages have gone up about 110% of how much the groceries went up, according to BLS data. In other words, over the past 35 years, the groceries have gotten a little cheaper relative to the median income. But my favorite example there is if you would have, instead of putting the $20.52 away to wait and come buy it groceries in 2025 for almost triple the amount, you put it in the S&P 500. Well, guess what? It's worth almost, I don't even remember the number from the book, $1,000.
I think it's like six figures in the percentage return.
It's way, way over what the cost is. And that's the whole point.
So how not to invest? Don't eat. Just invest.
No, the point is don't, Joan Robinson, one of the most famous female economists of the 20th century, said we study economics not to learn about the economy, but so as to not be fooled by economists. This is a classic example of, all right, you have to show both sides. If you're showing me the consumer spending, double entry accounting, you have to show me the earnings of income. But reality is, you get paid today. What do you do with that money? You pay your rent or mortgage, you buy food, medicine, clothes, occasionally some entertainment, vacation, healthcare, and you pay your taxes, and then whatever's left over, you invest in the market, you invest in your business, you invest. You don't put it away for a century.
Yeah.
Because that's what a medium of exchange is. It was never supposed to be a store of value.
So the one pushback to that is some of the comments were, this is an elitist take because half of the country doesn't invest. And if
most of the country doesn't invest.
Right. And so
they're absolutely right. I plead
guilty. If a lot of the
that.
money printing and debt really is if you own stocks, you've gotten totally rich. So some people consider a lot of the money printing was actually a regressive tax on poor people.
You're not going to get a push. So number one, my argument in Bailout Nation in the last book was there are these beautiful buildings downtown with these tall columns, and that's where all these banks should have gone to declare bankruptcy. The reason we had monetary repression and ZERP and everything else that came along post-financial crisis was, hey, we just spent trillions of dollars bailing out the banks and all these things. Let's not cause them to run into problems. We have all these assets on their balance sheet. If we normalize rates, I don't mean raise them, just normalize them, all this paper defaults and we have a problem. I think they're right. I advocated doing exactly that. Taking these banks down. Uncle Sam does a prepackaged bankruptcy. You send all these. However, here's where I'm going to push back a little bit on the elitist thing. You can't say to me, investing in stocks is elitist. Buy gold and Bitcoin instead. I mean, we're talking about, keep in mind, something like the top 10% of Americans hold 87% of all the stocks and bonds, right? It's only since the 60s that finance has been slightly democratized, but it's still a pyramid, and the top decile owns a lot. That said, if you want to say that there's inflation, you have to explain why you're going back 100 years, right? It just, none of it makes any sense if you just look at it for a moment and say, Well, I don't care. I don't get paid in $19, $17. I get paid in $20, $25, and I try and spend the money before it loses its value. I spend it, I invest it, I pay my taxes with it.
I don't know why they put him and a Bitcoin person on TV and just hit the record button. I'd watch that. Anyway,
by the way, 10 seconds on Bitcoin. The way, and I think I mentioned this in the book, the way I try and contextualize Bitcoin is it's a technology company, a little bigger than Facebook, a little smaller than Google. Suddenly, it's not a brand new asset class. It's not a new currency. It's a solution to certain types of problems that haven't become widely adopted yet. I think that's a fair description. And I own some. We own a little Bitcoin and Ethereum personally.
Hot take number 5, if you're counting.
Yeah, this one's we kind of covered this, but there's something inside of it that I want to bring up. Okay, so if you want to be there for the good times, you must suffer through the bad times.
Must.
Yeah, I mean, must is an interesting word here. I kind of agree with you. You know, Morgan Housel, who wrote your foreword, had this great way to frame it of volatility and down markets are the price of admission.
Yeah.
Because the other thing is, I'll just time around it, which does anybody really believe that's possible? If you resign to the fact that market timing is almost impossible, then you have to just hang in there pretty much. And that's sort of the cost of admission.
So 2 things. First, I more or less got the top right of the financial crisis and then went on TV the day before the bottoms and said, cover your shorts and go long here. And I'm the first guy to admit, I can't tell if that was skill or luck. You could have asked me the same question 30, 60, 90 days before or after. I would have given you the same answer, at least in terms of the bottom. So if I'm not willing, and I think a lot of people miss that, and if I'm willing to say, I don't want to rely on my gut to sling billions of dollars around.
COVID, I think, was like, everybody was like, oh, it's over. And then like, if you sold in like late March, you got screwed. You missed the whole rebound because who knew the Fed was, you just don't know these things.
The most amount of pushback to any Bloomberg column I ever wrote was April 1st, 2020, which was don't assume COVID ended the secular bull market. And there was no great insight. I based this on something Gary B. Smith wrote on thestreet.com in 2001, post 9/11. And if you go back and look at all the externalities that shook the market, everything from World War II and Pearl Harbor to JFK assassination to 9/11, what happens? Markets wobble. That's your emotional reaction. Some rationality comes back in, and then that sends them back to resume their prior trend. So when you have something from outside of the stock market, the economy, what have you, the assumption is, hey, we're still in a bull market. Why would you assume that this temporary setback? Now, I spent a lot of time why 20% is not a bear market. It's nonsense. So down 34% wasn't the reason to be out of stocks, and that was a very fast down 34%. But hey, if you can look through and say, it looks like a vaccine is coming, it looks like fiscal stimulus is coming, there's another side of this, don't just assume this is over. That turned out to be a good call, but it really wasn't a call. It was, I don't know what happens next, but here's what happened every time we had something like this in the past. And the point was, if you can just put these things into context and take a deep breath, you don't have to run around and have an emotional response. And every time we see a panic is pure emotion. So I'm sorry to have interrupted. I just wanted to, that was the most hate mail I've ever gotten, and it was delightful.
1.3% of public companies in the United States account for all of the market gains.
Right. So there's 2 numbers in here. One is 4%, 3 numbers, 4%, 2.3% overseas, 1 point something in the U.S. You kind of have to take out a bunch of other
but in short,
non-trading
there's
companies.
A tiny minority.
Right. That's what
did it all.
Henry Bessenbinder from Arizona State University did this study looking at the difference between long-term returns of stocks and bonds. And this was an accidental discovery that, most stocks are not important. You have some that are up a little, some that are down a little. They cancel out. You have the ones that eventually go to the pink sheets. So we'll remove all those. You're left with a tiny handful of stocks. And the big drivers, if you don't own those, you are going to underperform.
Only 1.3. And we're talking historical here.
I think the data went back to 19... I don't remember, it's 29 or 50. It's in there somewhere.
Morgan Housel's book had something very similar, and I've heard this many times. And this is, I think, one of the strongest cases for indexing.
Well, I was going to say, there's no way other way to get it.
Right.
Well, that's not true. That's not true. There is a way to get it. One, as we've seen the rise of quants and hedge funds, some of that school of approach is using a model to identify stocks that are going to perform well in the future by looking for the traits that have performed well in the past. The problem with that is the assumption that the future will look like the past. And so sometimes it works, sometimes it doesn't. There are two types of screening. You can either screen in for the stocks that are going to be in that 1%, 2%, 3%, or you could screen out the stocks that are the worst of the worst in the bottom 50%. And either of those give you a shot at creating alpha, but it still, despite that, the people who outperform the market, few and far between. It's not a majority each year. When you look at a 12-month process, you go to 5 years, 83% fail to beat their benchmark or the market. 10 years, it's over 90%. And when you go to 20 years, it's virtually nobody net of fees. It's a handful of names that we know because they are the exceptions that test the rule. It's Buffett, it's Lynch, it's go down the list of, I don't know, a dozen or two outliers.
Speaking of fund managers, one thing in here that I did not know, and I thought this was interesting, is fund managers are good at buying but bad at selling. So you're saying...
This is the next hot take, by the way.
This is the next hot take. It's based on a study you read, but I thought it was interesting because I hadn't really heard of it, and basically they're good at identifying good stocks. They're just horrible at selling them. And random selling actually outperform their own funds.
That's what's so crazy about it. So first, if you just stop and think about it, when you are selecting a stock, you are making a logical decision based on your expectations on products and revenue and profitability, and it's a pretty reasonable thought process. When you're selling a stock, it's somewhat emotional because it's either, oh, they're in trouble and I have to get out, or no, this is nothing, I'm not going to sell, and you watch it collapse, or, oh, these guys disappointed again, I've had enough. And those all seem like very emotional decisions. And the way the study did it is they would look at each of these managers' portfolios, and every time they sold, they would take a different stock in their portfolio and randomly sell it, and ran the parallel portfolios. And it was worth, I think it was worth about 100 basis points, 50 to 100 basis points. That's a giant number when you're looking for 7, 8, 9% a year. It's bonkers. But they're surprisingly good buyers. They're just terrible sellers.
I get that. I mean, if you're like mostly the Vanguard crowd, you would be just like put money in and never sell. So why would you expect them to know how to sell?
You sell individual stocks. They don't know how to sell individual stocks, and I think that's pretty clear. The Vanguard holders or the BlackRock holders, they sell when they need the money. They sell when they're buying a house or retiring or, generational wealth transfer, all that fun stuff. So it's pretty – there are reasons to sell, but the question is, are you selling a fund or an ETF, or are you saying, I'm going to sell XYZ? Usually they're selling XYZ in response to some external stimuli, or suddenly, ooh, who's the new shiny thing at the dance? Let's sell XYZ and buy ABC.
Next hot take.
Politics and investing don't mix. I think you make a good case here. I just want to make sure we're clear that you agree with both sides of the coin, because I find that, let's talk about ESG for a minute. I remember when the anti-ESG ETFs came out, you trash them. It's like you were triggered over them. But you didn't really talk about the ESG ETFs. I think they're the two sides of the same coin. It's active management in disguise. And if you trash one, you kind of have to trash the other. Do you agree?
Totally agree. But let me give you a little twist to that.
Okay.
So we're big direct indexers also, primarily for people who have concentrated stock positions and they're managing around a potentially giant capital gains tax. And part of the reason, this is the Canvas product that was originally O'Shaughnessy. It's now part of Franklin Templeton. And I want to say about $1.5 billion of our 5 and change is in that product. And we've gotten really good results. I was originally completely wrong about it. I assumed that would be for, to quote Meyer Statman, to have the investors' values be reflected in their portfolios, which is kind of what you heard leading into that. Really, the main request we get, I don't want guns, I don't want tobacco. That's the big twist out of that. But it's not, and that's for, I don't believe in these things, they're doing damage to the country, and I just don't want it, says some people. By the way, if you talk to the folks at the Canvas Group, they'll tell you the portfolios they run for the New York bishops' retirement plan. And like you can tune, hey, we don't want any abortifacients or anybody that's paying for, you could tune it to with great precision and take out what you don't want in that. So there are ETFs like Blessed and MAGA. It's Callie Cox is our market strategist. She ran a study and said, here's how much $100 invested in the market since 1950. It under Republican presidents, under Democratic presidents, and under all of them. And I'm doing it's a chart in the book. It's like $57 under Republican presidents and $72 under Republican presidents, unless I'm getting it back, and like $1,200 under all presidents. And so just making that bet seems to be really foolish. Another great study in there is looking at zip codes and seeing how people traded in response to presidential. So you could tell, is it a red or a blue zip code? And if it's a blue zip code and a red person is elected president, they move to cash. If it's a red zip code and a blue president is elected, they move to cash. Partisan bias that hurts portfolios knows no party. It's just human nature making bad emotional decisions.
Barry Ritholtz, How Not to Invest. Thanks for joining us on Trillions.
Thank you for having me.
Thanks for listening to Trillions. Until next time, you can find us on the Bloomberg Terminal, Bloomberg.com, Apple Podcasts, Spotify, or wherever else you like to listen. We'd love to hear from you. Hit us up on social. I'm at Joel Weber Show. He's at Eric Balchunas. Trillions is produced by Magnus Henriksen. Brendan Newman is our executive producer. Sage Bauman is the head of Bloomberg Podcasts.